On April 2, 2025, President Donald Trump sent shockwaves through the global economy with a single announcement. Standing before a crowd of reporters in the White House Rose Garden, he declared the implementation of sweeping new tariffs on goods from around the world. This move, he argued, was essential to protect American jobs and counter unfair trade practices by other nations. The decision marked a significant escalation in Trump's ongoing trade war, a conflict with potentially far-reaching consequences for the global economy. The new tariff regime is two-pronged. First, a baseline 10% tariff will be levied on all imports from all countries, effective immediately. This blanket tariff is designed to provide a broad boost to American industries and encourage domestic production. Second, targeted tariffs will be imposed on specific countries based on their trade relationship with the United States. These tariffs, ranging from 20% to 54%, aim to punish countries that the Trump administration deems to be engaging in unfair trade practices or contributing to the substantial U.S. trade deficit. Trump's decision was met with immediate condemnation from many world leaders and business groups. Critics argue that the tariffs will harm consumers, disrupt global supply chains, and potentially spark a global recession. Supporters, however, applaud the move as a necessary step to protect American workers and rebalance global trade in America's favor. The announcement has ignited a fierce debate about the future of globalization and the role of tariffs in the 21st century. As the world grapples with the implications of Trump's bold move, one thing is clear: the global trade landscape has been irrevocably altered. The coming months and years will reveal whether these tariffs will achieve their intended goals or ultimately prove to be a costly miscalculation. The new tariff regime is complex, with varying rates applied to different countries based on their trade relationship with the United States. The administration has released a detailed list outlining the specific tariff rates for each country. China, a frequent target of Trump's trade ire, faces the highest tariffs. A new 34% tariff has been added to existing tariffs, bringing the total tariff rate on Chinese goods to a staggering 54%. This move is widely seen as an attempt to pressure China into making concessions on intellectual property theft and forced technology transfer. Other major economies are also subject to significant tariff hikes. The European Union faces a 20% tariff on all goods, while Japan faces a 24% tariff. India and South Korea both face a 26% tariff, while Vietnam faces a 46% tariff. Taiwan, a major producer of electronics, faces a 32% tariff. These targeted tariffs reflect the Trump administration's frustration with these countries' trade practices and their large trade surpluses with the United States. Interestingly, Canada and Mexico, the United States' partners in the North American Free Trade Agreement, are exempt from the new tariffs. This exemption is likely due to the recently renegotiated United States-Mexico-Canada Agreement, which replaced NAFTA and contains provisions aimed at reducing the U.S. trade deficit with these countries. The administration has also included specific exemptions for certain goods from other countries, as detailed in Annex 2 of the White House order. The complex web of tariffs reflects the Trump administration's desire to use trade as a lever to extract concessions from its trading partners. However, the effectiveness of this approach remains to be seen. Critics argue that the tariffs will harm American businesses and consumers, while doing little to address the underlying causes of the trade deficit. The Trump administration has defended its decision to impose tariffs, arguing that they are necessary to protect American jobs and counter unfair trade practices by other nations. Central to their argument is the soaring U.S. trade deficit, which reached $1.2 trillion in 2024, a 40% increase over 5 years. This deficit, they claim, is evidence that other countries are taking advantage of the United States through unfair trade practices, such as currency manipulation, government subsidies, and lax labor and environmental standards. The administration has also criticized the non-reciprocal nature of many trade relationships. They point to the fact that the United States often imposes lower tariffs on imported goods than its trading partners impose on American exports. This disparity, they argue, puts American businesses at a disadvantage and contributes to the trade deficit. They also argue that foreign economic policies such as those that suppress wages and reduce demand for U.S. exports are harming American workers. The White House has cited significantly lower U.S. tariffs on goods like vehicles, electronics, and agricultural products compared to other countries. For example, the United States imposes a 2.5% tariff on imported cars, while the EU imposes a 10% tariff on American cars. This difference, they argue, gives foreign automakers an unfair advantage in the US market. The administration's arguments have resonated with some Americans who feel left behind by globalization and are frustrated by the loss of manufacturing jobs. However, many economists argue that the administration's focus on the trade deficit is misguided and that tariffs are a blunt instrument that will ultimately harm the US economy. They argue that the trade deficit is largely a reflection of macroeconomic factors, such as the government's budget deficit and Americans' high savings rate, rather than unfair trade practices. Section 4. Global Repercussions, International Condemnation and Countermeasures. The international community has responded to Trump's tariff announcement with a mixture of condemnation and apprehension. Leaders from around the world have denounced the move, warning of its potentially devastating impact on the global economy. The European Union, a major trading partner of the United States, has promised a united and resolute response, hinting at retaliatory tariffs on American goods. China, the primary target of Trump's trade war, has vowed to take all necessary measures to protect its interests, raising fears of a full-blown trade war between the world's two largest economies. The condemnation has not been limited to traditional U.S. allies. Australia, Canada, and Mexico, all key trading partners, have expressed their disappointment and concern over the tariffs. Even countries with historically close ties to the United States, such as Japan and South Korea, have criticized the move and are exploring retaliatory measures. The widespread condemnation reflects the interconnected nature of the global economy and the potential for Trump's tariffs to disrupt global supply chains and trigger a trade war that could harm businesses and consumers worldwide. The International Monetary Fund has warned that the tariffs could shave 0.5% off global economic growth, while the World Trade Organization has expressed deep concern over the escalating trade tensions. The WTO has urged all parties to engage in dialogue and resolve their differences through negotiation, rather than resorting to protectionist measures. However, with both the United States and China digging in their heels, the prospects for a negotiated solution appear increasingly dim. As the trade war escalates, businesses around the world are bracing for the impact. Multinational corporations are reconsidering their supply chains, while small businesses are facing higher costs and uncertainty. The tariffs are also threatening to disrupt global investment flows as investors seek safer havens for their capital. The uncertainty and volatility injected into the global economy by Trump's tariffs are casting a long shadow over the future of global trade. Section 5. Wall Street shudders. Market volatility in the face of uncertainty. The announcement of tariffs sent shockwaves through global financial markets, with stock markets around the world experiencing sharp declines. The Dow Jones Industrial Average, a key indicator of U.S. stock market performance, plunged over 500 points, or nearly 2%, in the hours following Trump's announcement. The S&P 500 and NASDAQ Composite, two other major U.S. stock market indices, also experienced significant declines, reflecting investors' anxieties about the potential impact of the tariffs on corporate profits and economic growth. The negative sentiment spilled over into Asian and European markets, with major indices in those regions also experiencing sharp declines. Japan's Nikkei 225 index fell by over 3%, while Hong Kong's Hang Seng index dropped by more than 2%. European markets followed suit, with the German DAX, French CAC 40, and British FTSE 100 all closing down significantly. The synchronized global sell-off reflected the interconnected nature of global financial markets and the widespread concern about the potential for Trump's tariffs to trigger a global economic slowdown or even a recession. The tariffs have also contributed to increased volatility in currency markets. The US dollar initially strengthened against other major currencies as investors sought refuge in the perceived safety of the greenback. However, the dollar's gains have been tempered by concerns about the long-term impact of the tariffs on the U.S. economy. Emerging market currencies, on the other hand, have generally weakened against the dollar as investors flee riskier assets. The volatility in currency markets is adding to the uncertainty facing businesses that operate across borders and rely on stable exchange rates for their profitability. The market turmoil reflects the deep uncertainty surrounding the Trump administration's trade policies and their potential impact on the global economy. Investors are struggling to assess the likely duration and severity of the trade war, as well as the potential for retaliatory measures by other countries. This uncertainty is likely to persist until there are clearer signs of a resolution to the trade dispute, or at least a de-escalation of tensions. Until then, markets are likely to remain volatile as investors react to each new headline and policy announcement.